Welcome, everyone, and thanks for joining us on our webinar. I'm Justin Wheeler, CEO of Berkadia, and I'm joined by Berkadia executives and industry partners to briefly recap the highs and lows of 2022 and discuss the themes we expect to shape behavior and the multifamily housing market in the year ahead. After a historic 2021 for the multifamily sector, the industry experienced an abrupt turning point in 2022. If you aren't aware of that, you haven't been alive. Entering 2023, we continue to live in an environment with high inflation, higher interest rates, and economic uncertainty. That said, the multifamily sector remains a favored asset class by many investors due to its underlying fundamentals and projected economic and demographic trends. For many reasons, I continue to be optimistic about the long-term potential of our industry despite some of the short-term headwinds. A tidal wave of maturing loans, a growing pool of yield-hungry investors, inherent market inefficiencies, and continued liquidity support from government-sponsored enterprises will continue to fuel investment activity and allow the skilled investor to take advantage of the full life cycle of real estate opportunities. One personal note, I am also especially excited about Berkadia and where we are headed. We continue our evolution from largely a transaction company to a full-service, industry-leading capital markets advisory company. It's been inspiring to watch members of our team make it their personal mission to assist our clients to find clarity and capital solutions amid the current economic landscape. That has required learning new skills, leveraging new technology, and increasing collaboration to ensure a seamless and best-in-class experience for our clients and our partners. I'm confident that our One Berkadia team will continue to come together more than ever to best help our clients build their businesses in 2023 and beyond. Today, we are fortunate to be joined by Aneta Markowska, Chief Financial Economist at Jefferies Financial Group, to help us better understand the current economic landscape and its impact on commercial real estate. Jefferies is our sister company, and it is a pleasure for us to find yet another way to work together to deliver even greater value for our clients. After Aneta's remarks, we'll hear from several of my colleagues at Berkadia who will provide broader market context to our conversation. Moreover, Sharon Géno, President-elect for National Multi-Housing Council, will be joining me to share her vision for the future of NMHC and the challenges she anticipates in the year ahead. We also have another special guest joining us today following this morning's announcement from Berkadia. Neil Brooks, Global Head of Capital Markets from Knight Frank, will be joining Keith Meisner, Berkadia's co-head of investment sales, to speak to our newly formed strategic alliance with Knight Frank. Our partnership is just another step in our growth efforts to provide our clients with unmatched access to domestic and internationally based capital. Berkadia's deep industry knowledge and experience in the U.S. will be accretive and flow seamlessly with Knight Frank's vast global footprint and valuation expertise to shift our institutional business into high gear. I'm really looking forward to his conversation. Now, without further ado, I will turn it over to you, Aneta.
So, hello, and thank you for having me. Our outlook theme for this year is from a stronger for longer expansion to a later but harder recession. Last year we spent much of the year arguing that the economy would actually be more resilient than many anticipated, and that we would not have a recession, that the consensus view on that timing would get pushed out. And that's still our view for the first half of this year. We do not expect a recession until the third quarter, but when it does hit, and we do think it will come at the end of the year, that it's likely to be a little bit worse than the current consensus thinking. But let me actually start with where we are relative to consensus, to kind of demonstrate that in picture. So the consensus view on the economy right now is that we'll see essentially no growth in the first quarter, then we'll see a slight contraction in the second quarter, and then back to zero growth in Q3, and then basically moderate growth thereafter. So it's the idea that we'll have a recession pretty quickly this year, but that it will be relatively mild. And frankly, this is such a mild recession that the consensus view is painting it's almost a borderline recession. So it is true that it's very much a consensus view, but I think the debate in the market today is really kind of around the severity, the timing, and the duration of that recession. And so we do ultimately see a little bit more pain in a pipeline, again, that's probably currently priced into financial markets. Inflation, I do think, is very much last year's problem, but it would sort of feel odd talking about the economic outlook without mentioning inflation. So let me just say a few words about it. Inflation is clearly slowing. Inflation has clearly peaked. That's very good news. And we do think that we'll see continued slowdown, although not all the way to 2%. Our base case is that basically inflation will slow to about 3.5%. That's core CPI by the middle of the year. And then it will plateau. So we do think that there is that little bit of a residual piece of inflation that will prove to be pretty sticky, and that's largely coming from the labor market. And you can actually see on this slide here, which decomposes the CPI into four major components: food and energy, which is clearly disinflating very, very rapidly. Core goods also disinflating very rapidly. That's clearly a sign of the healing in a supply chain, which is clearly underway. The problem is in the service side of the economy. Housing inflation is still accelerating. The way it's measured, it's a little bit lagged, relative to market rents. So we do have forward-looking data which suggests that part of the CPI will eventually slow sometime this year. But that leaves us with core services ex housing, and that is very, very closely related to the labor market. And that is that last piece of inflationary pressures that I think will be very, very difficult to squeeze out. And you can see that on the next page, which compares the CPI to unit labor costs, essentially showing, the portion of inflation or how much inflation is currently emanating from the labor market. Unit labor costs are currently up 5%, thereabouts on a year-over-year basis. With productivity improving, maybe we can push that down to 3.5%. But part of that is just simply wages being too high or wage inflation being too high. And so ultimately, we think it's very, very difficult to bring inflation down to 2% without pushing wage growth down to about 3.5%. And so that's depicted in this wage Phillips curve, and the red scatter plot, or the red dots, really show you kind of what's been happening in this cycle. And you could see that there's been a clear shift up in a Phillips curve, meaning that at any given level of unemployment, labor has enjoyed a lot more pricing power, a lot more wage inflation compared to the prior cycles. And that sort of is part of the soft versus hard landing debate, because if we stay on this very steep Phillips curve, it becomes essentially impossible to push wage growth down to 3.5%. That's what's consistent with 2% inflation, without putting significant upward pressure on the unemployment rate. The alternative path, or the only path to a soft landing scenario, would be somehow achieving that slowdown wage inflation without that upward pressure on unemployment. And although the last two data points do point in that direction, and that has raised some hope in the market that actually a soft landing might be achievable, I'm still very skeptical about the sustainability of those lower wage inflation prints, because the labor market is still very unbalanced. And that's what you see on this next chart here, which looks at job openings relative to the number of unemployed. And that ratio is still extremely high. It has come down a little bit from last year's peaks, but at 1.7, it's still, some of the highest readings we've seen in the last 60 years. So it's really, really hard to envision, without downward pressure on that ratio, without further reducing labor demand, how wage growth can slow sustainably. And you can see that, that there's sort of mixed evidence in terms of where wage inflation is running right now, although you have seen a little bit of a slowdown. But when you look at surveys of compensation budgets for this year, and you could see a number of those surveys on this next page, most of them suggest that the planned budgeted salary increases for 2023 are at least as large, if not larger, than what companies had to implement at the start of last year. And so this suggests that the slowdown in wage inflation that we saw in the last 2 months will be very difficult to sustain. So that is sort of part of our thesis, that it's just very hard to return to 2% inflation without putting upward pressure on unemployment, without really destroying a lot of labor demand, and ultimately creating recessionary conditions. But even if that's wrong, right? Even if inflation actually slows in a very benign fashion, the sort of so-called immaculate disinflation scenario actually plays out, I'm still not convinced that the economy can soft land in that scenario, because the implications of that high inflation that we experienced last year are already in a pipeline. And what I mean by that is, the Fed has already raised rates substantially, and you can see it on this chart, right? The Fed funds is, already at, over 4%, projected to rise to close to 5. We're calling for 5.10 being the peak funds rate. That's pretty consistent with what Fed officials are telling us. The market is skeptical. The market is sort of a little bit below that. But the point here is that in a 12-month time frame, the Fed has raised rates, or will have raised rates substantially, and we think that the effects of those hikes have not been fully felt yet. What are those effects? Well, when you run that Fed funds path through a sort of a very standard macro model, right, model of U.S. economy, what you are told, or sort of the results that the model spit out, suggest that peak policy pain in terms of sequential GDP increases actually isn't going to be felt until the second quarter of this year, right? And it's maybe even a little bit later. Now, this is a debate in the market today, because some economists, some analysts are arguing that actually policy lags are shorter right now, because the Fed gives us so much information about what they're going to do in the future, that those future hikes get transmitted through financial conditions very quickly, and financial conditions actually peaked in the third quarter of last year. And some argue the policy lags there are fairly short, and therefore we felt peak pain. My problem with that thesis is that when I look around, I don't really see peak pain anywhere. The only sector that has experienced any real pain thus far is the housing sector. But even in housing, demand declined very, very quickly, right, in response to the hikes that the Fed was delivering, again, because they got transmitted through the long end of the curve and mortgage spreads. But even in this most rate-sensitive sector of the economy, right, where you saw the impact on GDP and on demand very quickly, we still haven't lost a single construction job. So I would argue that, the lags to employment, which is what ultimately determines whether we're in a recession or not, are actually longer. Why? Because, and you can see it on this chart here, there were very long construction pipelines, backlogs, right? It took much longer to complete projects during the pandemic because of those bottlenecks, the supply shortages. And so even though housing starts or new projects have already declined pretty substantially from the peak, the number of units under construction has remained very high, because again, it's just been taking so long to complete those projects. But what happened late last year is, for the first time in this housing cycle, housing starts actually dipped below the level of completions. So you now have more projects being completed than started, and that means that the number of units under construction is likely to start to decline, and that in turn means that we might start to see employment or job losses in that sector. So again, in terms of employment, the lags from policy tightening, the job losses related to housing are actually quite long, and it looks like it will have taken about a year. Elsewhere in the economy, we think the lags are actually quite long as well, because financial conditions are not as important in transmitting monetary tightening as they were in the past. One, household and business balance sheets are very cash rich, and that means that, the credit is not a big driver of growth in this cycle, and it certainly has not been the case, right? So the credit channel, which again was very important in transmitting monetary policy to the real economy, is just less important. And what the Fed really needs to do is to lock up that cash that is already sitting on balance sheets And they can only do that by raising rates at the front end of the curve and then waiting for banks to actually raise deposit rates to create a disincentive to spend and an incentive to save. Another way in which policy traditionally got transmitted to the real economy was through wealth effects, right? The idea that if my portfolio declines in value, I'm going to spend less, or if the value of my home declines in value, I'll spend less. You can see on these charts that compare wealth to spending that the wealth effect has really not worked in 10 years. Even when values went up, households post the global financial crisis were just not inclined to spend against those unrealized wealth gains. And so because it didn't work on the upside, we think it won't necessarily work on the downside. So financial conditions are less important. We think policy transmission is skewed toward the short end of the curve. And that means that the Fed actually has to deliver those rate hikes before we can fully feel the policy impact. And we're obviously not quite there yet. Another thing I want to touch on, and this is also part of our kind of recession thesis ultimately, and that is the kind of the role that the savings play in the economy. And I bring that up because there's still a narrative in the market that we're not going to have a hard landing or we're not going to have a full-blown recession because households are sitting on a lot of cash. And that is true that from a balance sheet perspective, things still look pretty good. And actually, when you look at the accumulated, just backing up a little bit, if you look at the accumulated stock of excess savings that households kind of build up during the first 2 years of the pandemic, by just underspending relative to their disposable income, at the peak, those excess savings totaled about 2.2 trillion. By the end of last year, about half of that excess savings stock had already been spent. And if the saving rate remains at its current levels, and you can see on this next chart how low it is, it has already declined to just 2.5%. So yes, households did oversave for quite some time early in the pandemic, but then they now also been undersaving relative to normal for quite some time, and they've already burned through half of those savings. And if the saving rate just remains at these levels, they will continue to burn through that cash, and that cash will essentially be over by, we estimate, around November. But what's driving nominal spending growth is the change in the saving rate. And because it has already gone down so much, it really cannot provide any more firepower to growth momentum. So last year, nominal spending growth was up 8%. The drop in the saving rate contributed 5 percentage points of that, right? We just simply cannot repeat that. So if the saving rate merely stabilizes here, we lose 5 percentage points of growth momentum in terms of nominal consumption, nominal GDP. And that may not sound terrible, right? If nominal slows from 8 to say 3.5, 3.5 doesn't sound terrible at face value, but the problem is with what that will do to nominal revenue growth, because companies, were able to manage their cost structures last year because revenue growth was very strong in double digits. I think that as we see this sharp slowdown in nominal revenue growth, the managing the cost structures will become more difficult. And I just want to, before I move on to profit margins and what they will ultimately do to the labor market, I want to touch very quickly on real wages, because it is true that real wages are turning positive, and that is a near-term positive for the consumer. But ultimately, this is a zero-sum game, right? Last year, real wages were negative, but that actually allowed businesses to build margins, right? You essentially had consumers lose, businesses win, but the positive knock-on effect was that because businesses were still very profitable, they continued to hire, and that sustained the strength in a labor market. Right now that real wages are turning positive because inflation or pricing power is fading faster than wages, the flip side of that is that this will lead to a margin squeeze. And so this is really kind of a critical component of our hard landing thesis, is that we think margins are going to come under pressure, pretty significant pressure in the first half of this year because of that nominal slowdown in revenue growth and consumption. So let me show you here on this page what revenue growth has done thus far and what we think it will do. And I think it really demonstrates an important point. Last year, when you think about all the negative shocks that the economy experienced, the war, the price shocks, you had lockdowns in China, etc. And yet the downside of those shocks on GDP really didn't materialize. The economy at the end of the day last year surprised on the upside. It proved much more resilient than many anticipated because of that strong nominal growth, right? That essentially took care of a lot of problems. So even though it seems, looking at 2023, that things are incrementally getting better because, the war is still ongoing, but it's no longer an unknown. It's no longer a huge source of uncertainty. China's reopening, inflation is slowing. The Fed is, getting close to the tightening cycle. And so it seems like things are getting incrementally better, but the problem is that nominal growth that basically took care of all our problems last year from a business perspective is going to slow sharply. And we actually think that will create real fundamental issues for the business sector because costs are unlikely to slow as quickly. So if revenue growth slows to say 4.5%, but costs, compensation, interest, depreciation, rise at about 7%, that actually creates a lot of pressure on profits for the entire corporate sector, but particularly small businesses. And I think that ultimately creates downside risk for the labor market and for the consumer, because when businesses lose money, they very quickly switch to a cost-cutting mode. They lay people off, and that ultimately causes the labor market to turn. When we think about the labor market strength today, or the resiliency that we've seen thus far, I think it's really important to understand where that's coming from. And that's what you can see on this next chart here that shows business job openings broken down by business size. And this isn't really widely talked about, but the vast majority of incremental job openings that have been created post-pandemic are actually coming from the small business sector. Large businesses did initially increase their labor demand, but actually a lot of that has already reversed over the course of last year. It's really just small businesses that are still kind of hanging on and still, looking to hire more people. And what's driving that, or what did drive that last year, was that small businesses were actually very profitable. In fact, they were the most profitable that they've been in decades. You could see our very simple profit proxy for small businesses, which really looks at their ability to raise prices versus their ability to raise wages, or their willingness to raise wages. And they just, again, had a lot of pricing power, wages lag, that created a very profitable backdrop for small businesses. We saw an explosion in small business formations, and that led to a hiring boom. The problem is that profit pressure is starting to kick in. And when you look at what small businesses are telling us about their prospects for price and wage increases, or what they anticipate will happen in the next 3 months, that entire margin space essentially goes away. Why? Because they're telling us that they're no longer planning to raise prices, but they still have to raise wages if they want to retain and attract labor. And that implies that, again, a lot of that margin space will go away. Small businesses are also very levered to the front end of the curve, meaning they don't go to capital markets. They don't, have share prices to worry about and to optimize for. They borrow predominantly from banks, and they are there, and most of that debt exposure is floating, which means that they have not fully felt the policy pain yet. And that goes back to the point that I made earlier, that the most important transmission of monetary tightening is now through the front of the curve. And you could see it on this last chart here, which just shows the effective rate paid on small business loans. It tracks Fed funds very closely. So even though, 10-year Treasury yield has already peaked, there's still a lot more upside for the interest rates that small businesses pay on their loans. If the Fed actually does raise rates to slightly over 5%, small businesses in that environment will probably be paying 9.5 in terms of the effective rate on their loans. And that again creates a big problem when revenue growth slows to, low to mid single digits. So this all kind of goes to our thesis that those margin pressures in the small business sector will intensify in the first and second quarter, and that will ultimately cause bigger cracks in the labor market to emerge, and that will ultimately cause much more significant headwinds for the consumer and for the broader economy, and ultimately hitting even those larger companies that might initially be doing a better job managing their cost structures. And so, with that, our outlook is that the Fed will get to 5.1% in terms of their terminal funds rate. They'll probably hold it there for the rest of the year, because they will wait until inflation either subsides closer to 2% or until the labor market actually creates, we see some slack built in the labor market. We think they'll wait until the unemployment rate rises to 5%. And that's when they cut, and that's probably not until early 2024. But then we do think that they'll be in a position to actually cut rates pretty aggressively, and we could see the Fed funds go as low as 1.5%. So let me stop there, and I know that there are some questions, so I will turn it over to Dory.
Thanks for taking the time to be on today's webinar and providing your views on the current state of the economy and where you believe we're headed. As you mentioned, there were a number of clients who submitted questions, and I'd like to take this time to address some of their questions. The first question is, based on your economic outlook, what does this mean for Treasury yields and interest rates in 2023?
So I think the good news is that the yields have very likely peaked, right? Even though, even if the Fed continues to push through with hikes, and at this point it looks like they'll probably raise 25 in Feb, then again March, and probably in May. The market's sort of debating that May hike and whether the economy will still be strong for the Fed to deliver that last hike. We think that they will, but even if the Fed fund still has another 75 basis points to go, I think that a lot of it is already priced into the curve. And even if the market prices in a little bit more at the short end of the curve, I think simultaneously it will be pricing more cuts, more cuts, say in 2024 and beyond. So when we think about the entire term structure of interest rates, not just the next 6 months, but also what the market is likely to be pricing in going forward, and the 2 and 10-year Treasury yields will obviously discount that in advance. We basically think that those longer term interest rates have already peaked. We expect the 10-year to not necessarily move down dramatically, but probably get down to about 350 by the second quarter, and then down to about 3.25% by Q4, and probably should see an even steeper decline in a 2-year, particularly toward the latter part of the year, because by that point, if we are in a kind of hard landing recession that we envision, I think the market will have to price in a lot more cuts in 24 than is currently priced into the curve. As of today, the market's essentially projecting that the Fed will get down to 2.5% and then plateau there, basically a perfect soft landing, right? As we get to that longer run neutral rate, we think that they could actually cut below that. So as we get closer to, again, the end of the year and move deeper into that recession, I think there is more downside particularly for that 2-year yield, which will at some point capture that entire easing cycle.
Okay, great. Yeah, thank you. That's a great response, because I know a lot of our real estate clients are on just looking for some transparency and guidance and clarity surrounding interest rates and where they think treasuries are going to be. So thank you. The next question is, Jefferies is forecasting a higher level of unemployment than the consensus. That's almost 2 percentage points higher than the highest estimate at the Fed. Can you elaborate a bit more on how that level of unemployment may affect multifamily real estate and commercial real estate as a whole?
Absolutely. So let me actually start by just explaining really quickly why we're quite a bit higher. So the Fed thinks unemployment will peak, just under 5%. We're at 7. And part of the reason for that is we think that as the economy goes into a recession, what you typically see is a negative feedback loop, right? You have some layoffs driving weakness in end demand, and that ultimately leads into more layoffs. And you really need a policy backstop in the form of either fiscal or rate cuts to break that negative feedback loop. And we're making an assumption that the Fed just won't step in right away because we'll go into that recession with inflation that's still likely elevated. The Fed will probably want to see the unemployment raise right to what they think is the current natural rate, which is about 5%. And so for 2 quarters, roughly 2 quarters, without that policy backstop, again, those negative feedback loops will feed on themselves and essentially kind of allowing that downward momentum to accelerate. And that just means that ultimately unemployment overshoots, right? So even if it, 2% inflation, in theory, we can maybe get there with 5 or 6% unemployment. We think there's a good chance that we'll end up overshooting that, albeit not until probably middle 2024. So it won't be quite as high as the last 2 downturns, right, where unemployment reached double digits, but it will be sort of roughly consistent with the early 90s and early 2000s recessions. So yes, it will cause some stress for households. To get to 7% unemployment, you're talking about somewhere between 5 and 6 million job losses, which is quite a large number. And that's a lot of, renters, potentially, borrowers that will experience some stress. And yes, you will see a spike in defaults and delinquencies and unfortunately missed payments.
The Fed has been pretty clear about wanting to get inflation back to 2%. When do you think that will occur? And do you think there's a chance that the Fed just accepts a higher level of inflation as their target?
I don't think we get there very quickly. In fact, I think it could take another 2 years or maybe even a little bit longer. But I feel firmly that the Fed will not cave on that 2%. Because caving on that 2% and actually raising it implicitly or explicitly, I think potentially has more damaging implications than actually sticking with that 2% and raising the funds rate to whatever level is necessary to get us there. If the Fed, let's just say for argument's sake, explicitly comes out and says we're going to be fine with 3% inflation, well, the entire Treasury curve has to reprice at least 100 basis points higher, right? Because what drives Treasury yield is expected inflation, expected real rates. So on a 10 to 30-year maturities, you would have to reprice at least 100 basis points higher. I would argue even more because the market's going to have questions and doubts about, will the Fed actually stick to that 3% objective? So I think this potentially de-anchors the entire Treasury curve. And I think, it doesn't really do us any good and potentially could cause even more damage. And for that reason, I think it's extremely unlikely that the Fed takes that risk.
Okay, great. Well, that concludes our Q&A for today. Thanks again, Aneta.
Thank you.
Thank you, Aneta, for sharing your perspective about the impact of the Fed's action on the economy and your expectation as to how their agenda might play out in 2023 and beyond. Although I think we all wish you saw more rainbows on the horizon in 2023 instead of an extended period of overcast skies, we know that the fog will eventually clear, and soon we'll all find ourselves on the doorstep of the next great cycle. We're all anxious to understand what that new normal will look like so that we can adjust our strategies and develop our business plans accordingly. But until we know just how and where asset values will stabilize, how might we best prepare to access the opportunities that will most certainly arise? Investors should look for sellers who have the need to create liquidity in their portfolios to manage redemption queues, or for sellers with loan maturities that can't be refinanced at current rates because of leverage constraints, or for sellers with assumable financing. They should consider recap options where one partner needs or wants to sell and the other partner wants to stay invested. Investors looking for yield should consider niche markets within the apartment space. Build to rent and workforce housing are niche markets that do seem likely to overperform. Investors will want to consider the product types and submarkets that are likely to experience the greatest demand during the new normal. They should look for investments in markets with manageable political and climate risks, as well as properties that are being future-proofed with features like managed Wi-Fi. Investors should look to align themselves with sponsors that can execute well-managed and efficiently capitalized affordable housing strategies. They should consider value-add investments that address both ESG and DEIB concerns. Investors should look to invest with management companies that have the digital technology to minimize payroll costs, and with sponsors that understand the metrics of successful office to resi conversions. So, what do investors need to know to prepare their business plan for the next cycle? Well, as interest rates stabilize, investors will want to know real time the pricing metrics for deals that are making every day. Investors will want to know the new supply and the net increase or decrease in rental households they might expect in every primary and secondary market during the term of their hold. Investors need to understand how differing back-to-work protocols affect the type of product and the locations that tomorrow's renters will demand. Investors know that it is virtually impossible to build brand new housing that makes sense at affordable rents. But they also know that California and Texas found ways to use real estate tax forgiveness to fund affordable housing conversions of existing inventory. Investors need to understand if there are similar public-private opportunities in other major markets. Investors know that many office, hotel, and retail markets are overbuilt, but they also know that not all of these struggling commercial properties make for cost-effective conversion opportunities. In fact, few of them probably do. But investors need to understand the profile of various types of commercial properties that do make for the best resi conversions. Investors expect many states will follow California's lead in restricting the sale of ICMs after 2030. That year is only 7 years out. Investors need to understand the costs and potential revenues of adding electric vehicle charging stations to various types of apartment product. So how is Berkadia preparing to help our clients answer those questions and address their needs? Berkadia continues to invest in its advisory team. Our advisors will call on you to help you understand how deals are getting priced real time, what kinds of deals are attracting the most interest, and how those deals are getting capitalized. Berkadia continues to invest in technology that will help us all see around the corners into the opportunities in the new normal. Berkadia intends on hosting webinars and publishing white papers to help our clients prepare for the new normal as it comes into focus. Finally, Berkadia will offer insights and resources in debt, equity, and now in 2023, foreign capital. We want to thank all of you on this call for your friendship and your support in these uncertain times. We look forward to visiting with all of you in 2023 to listen to your needs and to share with all of you our abundant resources. We are committed to helping all of our clients make the next cycle in our business the very best one for all of us and for our communities. Now, I'll turn it over to Ernie Katai for a brief Berkadia production update and what that means for you.
Thank you, everybody, for joining us today. I'm going to take you through a little walk down the history of Berkadia. For those of you that don't quite know the history of the company, it started back in 1994 with a company called GMAC Commercial Mortgage. Probably the reason I'm telling you this story is it's about the time I was around here, so I'll walk you through it. But it was a company that a lot of people didn't know that we were international in that we had offices in Canada, United States, Mexico, Europe, and Asia. So that's something that was probably a little unique from where we sit today. And then we went from there to 2006. GM was strapped for cash. They put us up for sale, and we had Goldman Sachs, KKR, and 5 Mile Capital come into the equation and buy the company. Now, that was a company called Capmark, which some of you on the line here might remember that. We then, in 2009, and this is a fact that you might not have known, were in bankruptcy due to what the market was doing and in the financial crisis. And that's when the joint venture was formed between Berkshire Hathaway and Berkadia. Berkadia is now Jefferies, thus the very creative name Berkadia. Anyway, with that said, we fast forward to about 2013, and that's really when we started to look at being a full service provider and the acquisition of Hendricks and Partners. And in that time, as the company grew and we added producers, that type of thing, we started moving up into the institutional space. And in 2021, this is really what took us into the institutional space in a big way. We had the acquisition of Moran and Company, and I got to tell you, that has been one of the best things that have happened to Berkadia in a long time, with the creative solutions and the things that are coming off that platform. I'm excited today. You're going to hear a little more about it when we get done here, but we're going to announce the formation of an alliance with Knight Frank. I think that you will see this will start to expand us into more a global reach on certain things and certain things that we're going to be doing going forward. With that said, let's talk a little bit about the year and a little bit about where we are today. As you can see by the numbers here, the last couple of years have been amazing for Berkadia. If you look at the mortgage banking numbers, about $75 billion in production over the last couple of years, and if you look at the investment sales, we're at about 40. What are we at there? We're about 49 billion there. So again, considerable growth when you look back at 2014, where we did, $4 billion in investment sales and $10 billion and $10.5 billion in mortgage banking. Probably one of the things that we're most proud of is our servicing book. We're at about $393 billion. I'm walking around already saying we're at $400 billion. Mark McCool wants me to remind you that is not actually the number yet, but confidence in our servicing group that we'll get to that $400 billion. And that's really a key asset and leg of the stool for Berkadia as we look to our clients. And when we do deals, we plan on, the term of the loan, you're going to talk with us and be with us through the process. So that's a big part. Let's move on from there and just kind of a little bit of focus on investment sales. And something that I think you should note is that, and again, it's this moving into the institutional space, we did about $16.8 billion in institutional transactions. So with that said, we have 150 investment sales advisors. And you can see here we've got offices all across the country, 50 offices and that type of thing. We look at 800 plus properties a year and thousands of transactions. So again, as you think about us, looking at the banking side of the equation, something that we're absolutely thrilled for the second year in a row. We're number one with Freddie Mac. We're number 2 or 3 with Fannie Mae, and number 1 with the combined Freddie Mac, HUD, and Fannie Mae. So again, we continue to really grow in the banking segment, and just now with Moran and Company on the investment sales side of the equation, it's been a great addition to our platform. Looking on from this, you always got to have a Warren Buffett quote, right? Never invest in a business you cannot understand. If some of you look back and remember when the tech boom was going on, and Warren himself said, "I don't understand it. That's why I'm not investing in it." They quickly said, "Look, he's the guy that doesn't have, he's getting old. He's past his good in understanding what this business becomes." About 6 months later, the tech crash happened, and the smartest guy in the room once again was Warren Buffett. So I love this quote, which leads to our next slide, where we talk about the fact of the power of the specialty that we have at Berkadia. And, a lot of us, know us for the multifamily housing, but when you look at this list of affordable housing, this has really become a major player in the industry just because of the concerns going on politically and the housing crisis, that type of thing. Hotels and hospitalities, they came roaring back after what was a very rough couple of years of COVID. Institutional solutions, that's the Moran acquisition and that team, which you'll hear more and more about as the day goes on here. Manufactured housing, single-family rental and build for rent, that continues to be a very big growth area. In fact, Berkadia got ranked the number 1 lender and the number 1 investment advisor on the sales side for that category. Senior housing and healthcare, we've continued to be in that segment. and of course student housing. But we actually have a new one to introduce today. We have moved into the medical and life science business. We are very excited about that platform and that team that we've built there. So look for more to come on that into the future here. I want to take a minute and look and talk about what we're seeing with workforce housing. This is something that is going to be something that we have to address and look at going forward. We want to be solutions driven here at Berkadia. But if you look at this chart here and you look at where the median household income is and effective rent, that's the biggest jump that effective rent went up in the last 25 years. So again, that just accentuates the problem at hand. If you look at this next slide, you will see that the cost, the burden of housing, and really when we look at rent burden to household, it really is that 30% of household income number. If they're paying more than that, then we really do have an issue with stress on the financial situation. And if you quickly look at the bottom of this and you look at those people that make $35,000 or less, the pressure just continues to mount. And in every single one of these categories up to plus 75,000, people are paying more. They have a bigger burden, rent burden, than they had even the year before. So again, as we think about the future and being solutions driven and affordable housing, we certainly want to be your advisor and talk to you about that. With that all said, I'm very excited where we sit today, looking at the future, the opportunity that's in front of us. And, during the year, feel free to reach out to us as we, every day we're in the market transacting. And we're a little bit of that period where as the end of the fourth quarter, things started to really get quiet. And now we're picking up momentum as we're starting to get into our conference season, the NMHC and those type of things. We don't have to be the biggest. We just want to be the best. And with that said, I'm going to kick it over to Keith Meisner for just some more interesting information on what's going on at Berkadia. Thank you.
Hello, everyone, and thank you for joining our annual webinar. As Justin mentioned earlier, today is an exciting day for Berkadia. This morning, we announced our partnership with global property consultancy, Knight Frank. This newly formed alliance will offer Berkadia's clients greater connectivity to relationships to the world's most active investors, spanning all key capital hubs across the globe. I'm happy to be joined today by my new partner, Neil Brooks, an industry veteran and global head of capital markets for Knight Frank, to elaborate on what this partnership means for Knight Frank and Berkadia, as well as our clients. Neil, thanks for joining us.
Hi, Keith. I'm very pleased to be here and to be launching the alliance with Berkadia. Knight Frank's very active in the capital market space in the UK, Europe, Asia Pacific, and Middle East, and looking forward to accessing the US market in partnership with Berkadia.
Yeah, the Knight Frank and Berkadia alliance came together pretty quickly, and one of the reasons it came together quickly is after we first met, we realized that our cultures and our areas of expertise were just so complementary. Being a people-first, mission-driven company, and you all are client-centric as well, and community-focused mindsets, integrity first. Boy, we just couldn't be happier to be in a global partnership with you all and look forward to great success.
Yeah, I think we're all really pleasantly surprised within the first hour or so of getting to meet each other, looking at the cultural values and the alignment we have. So Knight Frank is the largest privately owned property consultancy in the world. Berkadia is obviously privately owned also. And we really felt that the alliance of the two groups allows us to focus on our clients with a long-term perspective, not driven by quarterly earnings, and really kind of work with our clients in partnership.
Yeah, we couldn't be in more of alignment in that regard, and we're very fortunate to be in that position. The way this is going to work and be valuable to our clients when we're selling their properties for major transactions, we are forming an international desk, and it'll be manned by a Knight Frank personnel as well as Berkadia personnel, and that's the conduit, that's the funnel for all information to get effectively into the Knight Frank network, to maximize the visibility of the property, the opportunity to take that to the market and maximize pricing.
Yeah, that's right. I think the key benefits of the relationship are capital coming into the States. Offshore capitals increased substantially over the last 5 years. Coming into the US. Between us now, our network is 558 offices in all the major capital hubs across the world and over 23,000 people. So we've got access to the most aggressive sovereign wealth, institutional wealth, and particularly with Knight Frank, access to private wealth. Some of the institutional investors are more impacted by the increase in the cost of debt, but we are seeing private investors looking to enter the market. And the US is, it's the most in-demand market in the world. So our clients, particularly out of Asia Pacific, are really keen to get into the US, and that's into the living sectors, multifamily in particular, into life sciences seems to be a really hot area at the moment, and healthcare as well. And also into the debt space. That's increasingly becoming an area which we're asked about from our clients in Asia Pacific and Europe.
Neil, that's another example of the alignment between Berkadia and Knight Frank. I mean, the culture aside, but all those sectors you mentioned, the living sectors of multifamily and life sciences and healthcare and hotels and hospitality are what we specialize in. So we are so excited to be able to take our property listings and service our clients in a better and the most efficient way to maximize returns for them. And I think we're all going to benefit.
Yeah, that's right. And it is exciting for Knight Frank as well, because our clients, they need access to that product in the States. If you look at the type of transactions we've done over the last 5 years or so, it has tended to be Korean, Japanese capital, and a lot of Singaporean capital coming into the US. We see that trend continuing over the next 5 years and probably increasing. We're also really looking forward to working with US investors coming into the Asia Pacific markets, Europe and UK. The US is the dominant buyer group in those markets. But we see an increased capital flow from the US, particularly into the UK over the next 12 months, and selected markets in Asia Pacific. And we really think that capital is going to be focused on the living sectors. The growth in living sectors is being signaled by all the investor sentiment surveys that we're conducting, but also the industry associations, and that we think it's going to be massive growth in the multifamily space in Europe and Asia Pacific. So a big focus for us.
Well, Neil, with our institutional relationships and other relationships with capital that wants to go back across the pond that way, we are more than happy and look forward to working closely with you in that for everyone's success.
Yeah, that's great. And one of the other aspects we came together on was looking at the clients we work with in our markets. There's kind of an 80% crossover with the clients that Berkadia works with as well. So I think us combining our resources and our client relationships is going to increase the service we can give to those clients substantially.
Yeah, and more importantly, the results for them. So
exactly.
Welcome, Neil. Look forward to it.
Thank you, Keith. Looking forward to it.
Thank you, Keith and Neil. We could not be more excited about this new partnership with Knight Frank. I'd also like to thank all of our customers and lending partners who have joined us here today. To know where you're going, it actually helps to know where you've been. And it feels like we were just about everywhere in 2022. It was a lifetime ago, but let us take a quick jaunt back to January of 22. The Fannie and Freddie caps had just been lifted to $78 billion each. The MBA was projecting a 31% increase in debt originations for the year, and multifamily specific projections were also bullish, a 25% year-over-year increase. 10-year Treasury was around a 175, and we were still questioning whether inflation was transitory. The Federal Reserve had yet to do a single interest rate hike. That's right, the Fed funds rate was still at 0. Floating rate caps were also affordable. A 4% strike on a 2-year cap cost a whopping 9 basis points. And debt fund and bridge options also abounded. There were over 100 different funds in the market at this point last year. So I think it's safe to say that the optimism surrounding the market had everyone feeling pretty good. Now, just a few minor contrasting points for where we are today. 10-year Treasury is hovering around a 350 so far this year, which let's all agree is still pretty good. Per the MBA, total commercial and multifamily mortgage borrowing is expected to fall to about $700 billion this year, which is about a 5% decline from what they project for last year. Depending on the source, multifamily alone is expected to decline about 5 to 10% this year, originating about 400 to 440 billion of multifamily loans is what is projected. Interest rate caps for floating rate debt have gone through the roof, but Fannie and Freddie each have a $75 billion cap for 23. So as we kick off 23, Berkadia is expecting the landscape to continue to shift over the course of the year. As we heard from Marianne earlier, we have the belief and the hope that once the Fed stops hiking interest rates, it will allow for price discovery to occur in the investment sales market. We do think volumes will be backloaded for the year. Price discovery also means that capital stacks are going to look different than they did 2 years ago. Call it rescue capital, preservation capital, preferred equity, whatever you want to call it. As price discovery occurs in the market, it's important to know how to access capital up and down the stack in order to keep transactions flowing. And it's an important time to be able to partner with a firm that can help you navigate that entire capital stack. Berkadia has both advisors and an entire JV equity and structured capital team that specialize in arranging this joint venture equity and structured capital from a broad range of more than 400 different domestic and foreign capital relationships. So please reach out. As you also heard from Marianne earlier, there has been a significant slowdown in sales activity. Many properties are well positioned to still cover their debt service, and owners may not be incentivized to sell right now. But there are still maturities and construction completions coming to the market this year. As you can see on this slide, an estimated $200 billion in multifamily maturities come due over the next 2 years, and we have about 550,000 multifamily units coming online this year. As you can see, the cost of caps have dramatically increased as well, and these aren't just a factor for sizing agency floaters, but also in extension tests for CLO and debt fund deals as they come due. And as these maturities hit, we will continue to see some real price discovery. And with that price discovery will come some good opportunities for our clients. And we expect that the GSEs will be in prime position to assist our clients with these financing needs. The GSE's ability to provide financing in down markets, their near-stable product and pre-stable products, and the ability to provide select clients with a credit facility option will combine to make them a very attractive source of debt in the coming year. Focusing a little more specifically on Berkadia, as Ernie said, last year we originated $34 billion in financing for our clients. This was over 1,600 transactions, and it was the second highest year of originations in our history. At just over $11 billion and a 15% market share, Berkadia maintained our number one ranking with Freddie Mac for the second consecutive year. We also remained a top Fannie Mae lender, coming in as number 2 nationally last year with Fannie. As Commercial Mortgage Alert highlighted last week, Berkadia was last year's top originator of multifamily mortgages in structured agency securities, so we're very proud of that. And our top-ranked HUD platform produced more than $1.5 billion in debt financing last year, over $3.8 billion in life company originations, and in all of the $34 billion, we placed debt with 285 different bank and lending partners. So thank you to all those partners who stood side by side with us last year. Looking forward to 23, we know that there will be challenges in the market. That road to price discovery could be bumpy. And although there will be economic challenges and uncertainty, we believe this will bring opportunity, and there will be many of those this year. In addition to Fannie and Freddie, life companies and banks will continue to be players, and there will be significant construction takeout opportunities. Berkadia anticipates a further increase to our lending volume this year as we commit to our clients to have the best-in-class execution across the board as we travel together this road of price discovery in 2023. And with that, I want to thank all of our clients and our partners who are on the phone today. And I also would like to turn it over to Justin for the next segment. Thanks, Justin.
Hello again. I'm thrilled to be joined by Sharon Wilson Géno, President-elect for National Multi-Housing Council, and a 30-year veteran of the housing industry. When Doug Bibby steps down as president at NMHC's annual meeting after 20 years at the helm next month, Sharon will assume the role of president. Hi, Sharon. Thank you for joining me. Would love to give you an opportunity. A lot of people probably aren't familiar with you who are on this call. Would love to give you an opportunity to introduce yourself and maybe kind of how you came to be where you're at today.
Sure. No, thank you, Justin. As you mentioned, I've been in the housing business for about 30 years now in a variety of different capacities. My educational background is both as a lawyer, but also as a master's degree in urban policy. So I've looked at it from both sides of the house. Much of my work, as you mentioned, has been in the affordable space, and I spent a good chunk of that time in the public housing program. So also on the advocacy side of the public housing program. So learning housing advocacy from that place 25 years ago, when we were really first embarking on public-private partnerships. And so that has been enormously valuable experience coming into this role, both understanding how the advocacy world works, but also any solutions that we have to our housing supply problem are going to require public and private players to work together. Also, having been a lawyer on those transactions, I've been in the inside and the outside of those deals. So I do bring that background as well. But the opportunity here for me to come to NMHC is really this unique moment in time. Housing, those of us who worked for a very long time, housing was sort of a sleeper issue. You would knock on congressional doors. They would say, "Who wants to talk about housing? It's not a problem. We're not interested." Now everyone is interested. So the opportunity to really take all these different experiences that I had and put them to the possibility of creating new housing policy in this country is too juicy to pass up.
Just a couple of questions for you, and I'm respectful of your time. What recent or anticipated policy issues are at the top of the list for you at the NMHC?
Wow, well, there are a lot. Coming into this role in October, and I'll officially take the reins in February, housing has never been a bigger issue on the national stage or in state and local jurisdictions. So there are a number of issues floating around. I think most of them emanate from two different buckets. One of them is housing affordability. And there are a number of proposals that have been floating around in that bucket, both on the federal level, but also on state and local levels as well. And a lot of this is a reaction to the market adjustments that have happened, particularly over the last 6 to 9 months coming out of the COVID pandemic. When you have a significant economic disruption like the COVID pandemic, and we've seen this in other marketplaces as well, we're due for an adjustment. And a lot of that happened over the summer, and I'm sure your folks have seen that as well. The other related component to that is this issue of rent stabilization. And most of that is happening on the state and local level. And again, a lot of that is a reaction to coming out of the COVID pandemic, some of the market correction that had happened, particularly over the summer. But much of that has started to dissipate already. And again, I'm sure you're seeing it as well. Our research is showing that rents are already starting to come down a little bit, and the market is starting to adjust after the pandemic. But both of those I see as branches rooted in the same trunk, which is housing supply. We simply do not have enough housing in the right places that suits the population across the country. And that's an issue that we've got to address. The other two, in my view, are more symptoms of that problem. But if we don't get to the root, we're not going to ever get to it.
And what role do you see the NMHC playing in that NIMBY conversation?
And that's like a whole nother issue that's even part. All these issues are sort of tied together. A lot of our role has traditionally been and will continue to be being good stewards of facts. And unfortunately, that's gotten harder and harder to do in this world. But we want to be honest brokers and representatives for those of you in the industry for what really are the facts. What are the challenges that are being faced? What are the root causes of housing supply? And how do we get to those? Those of us who've been working in the housing field for a number of years, we are all housers. We all are advocating for housing. What we may differ on is how do we sort out the solutions and really come up with some that are effective. And a lot of that is education in communities, right up boots on the ground. Most of our work at NMHC is done on the federal level. But that trickles down. So it's really informing federal lawmakers about the issues that we're seeing in other parts of the country, so they can, and the solutions that we're seeing in other parts of the country, so they can take those back to their local states and communities and really advocate for the opportunity to have on more of the national level.
Well, we certainly appreciate the efforts made thus far and look forward to great efforts on the policy level. Outside of kind of policy, what are some other challenges or opportunities you see that the NMHC can weigh in on?
Really seeing a whole sea change, and it's even bigger than some of these policy issues, but their reactions to them, of just how rental housing is viewed generally speaking, and how renters are viewed generally speaking. We as housers provide a service. It is a roof over people's head. It is essential. We build homes so people can build their lives. And coming out of the COVID pandemic, where we see a lot more mobility, people being able to work remotely, people being able to move from place to place, we structure our economy based on a more mobile population if we don't have enough housing supply. So I think a role that we have to play here is not only telling the story of those of us who are in the housing industry and showing that this is producing housing is a very good and important both financial but also social endeavor, but also that the people that we house are good, responsible citizens of any community, whether they're there for a year, 3 years, 6 years, or permanently. And I think that's a broader role we can play as well.
I love that. And I love that term, we are housers. I really like that. I may be borrowing that, so thank you for that. Under your new leadership, do you have a long-term vision or long-term plans for what the NMHC, where it's headed?
It's really around listening to members' challenges coming out of the pandemic. The world has changed. The landscape has changed. And in response to that, as we've seen from these various policy proposals, and I saw in an article today, someone likened it to the American Revolution. We are truly seeing a revolution in how housing is being viewed as a nation. We have not invested in housing like we've invested in defense, like we've invested in transportation. And we've really only had any housing policy in this country maybe for the last 90 years or so, and it's always been sort of nipping around the edges of private market players and really relying, as you know, very heavily on the private market. As we move into this new era where housing is having a moment, ourselves as your representatives in Washington and support you as members on the ground in a new way that helps us take that message forward. So I was very interested in this position largely because this is a really unique moment in time. And I'm excited about working with the team here. We have a great staff on a new strategic plan, which we're going to kick off in the spring, on how we as an organization change and support you better, the stories we tell, the facts we get out.
Another question, you obviously, your latest stint was in an affordable housing focus, but you talked, and I've heard various conversations that you've had with people also about the importance of the conventional part of the market as well. Any kind of thoughts around serving kind of the two masters of the affordable and the conventional, and how those go together, maybe compare and contrast for the NMHC?
All things are kind of starting to slide together. Mm-hmm. Many of our members who are developers and operators who have not been in the affordable space before, might be in it a little bit. Some of them who the whole advent of built to suit single family rental is also kind of flying around out there. Two blends, what we used to segment the market very carefully. I think also senior housing, that's an area that's always been a kind of different market segment. And as our population grows and changes, and more people, the pandemic has taught us, can live in their homes longer, be them rental homes, be them single family homes that they own, with health support services. How do we create members maybe offer a multitude of different product lines that support people in different geographies? So I think that is a really interesting issue facing this organization. And while the conventional market and the affordable market continue to have different market dynamics, increasingly these policy issues are bringing them together. And how do we talk about those as a continuum, perhaps, and not as a wall between each of these?
Great. I really like that. Thanks for that. Another thing, there's going to be a couple thousand people listening to us, and their owners, their sellers, their operators, there maybe even a few competitors of Berkadia. Any message that you'd like to give as you embark on this new step in your career?
Really, we need all voices, especially at this really unique time. And both the issues I mentioned before, the issues around affordability. We need every voice on the state, local, and federal level talking about solutions that you are already providing in this space, and that there are solutions in helping inform not just federal lawmakers, but trickling down to state and local lawmakers who are increasingly having a role to play. Same thing with rent stabilization. Being that people understand that all the research shows that rent stabilization is not an effective tool for increasing supply or for housing people that are underhoused or don't have housing in this market. And really telling that story based on their own personal experience. We are going to be asking people for data and assistance in helping provide both those stories, but as also hard facts that we can use in this advocacy role will be much appreciated.
Oh, I'm excited to hear that. I'm excited for your leadership. We've been longtime supporters of NMHC, and we're continuing to do so, and certainly encourage those listening to participate. And thank you for soliciting a variety of opinions. That's always the fun part about this industry, is I've not found there's a paucity of opinion. So I think that you'll be managing and juggling lots of balls, Sharon, in this new role. Wonderful. Thank you so much, Sharon, for spending some time with us. Certainly wish you the best in the new position. We're confident that you'll take Doug's legacy and take it to the next level, and we're all excited to help you out.
Thank you, Justin, and thanks to all of your team at Berkadia who does the hard work every single day.
With that, we'll bring our discussion to an end. Thanks to everyone who shared your insights. A special thanks to Aneta for sharing her research and its implications. For Sharon, for joining me for an insightful conversation ahead of next week's NMHC annual meeting. And lastly, to Neil Brooks, our new partner. And thanks to all of you who joined us today. As a reminder, a recording of this webinar will be available shortly, and our complete 2023 forecast, an analysis of national multifamily trends paired with market-specific highlights, is available for download at berkadia.com. As always, please don't hesitate to reach out to any Berkadia professional with questions or follow-up. She or he will direct you to the right resource to get you the answers and insights you're seeking. We're here for you. Cheers.